Good morning. It's Monday, May 8th, 2023. I'm Lee Hall with Harvest Investment Strategies, and you're watching the Week Ahead video, where every Monday we update our clients and network on what could be impacting financial markets during this week. I want to apologize for not posting a video last week as Jared and I were traveling to Russellville and meeting with some of our Central Arkansas clients last Monday. We hope that everyone enjoyed their first month of spring, rounding out April, and are looking forward to the nice weather that May generally provides. Before hitting on what's happening this week, let's overview the last 2 weeks of market action. The S&P 500 index edged up 0.9% 2 weeks ago and down 0.8% last week, leaving it flat over the last 2 weeks. Q1 GDP estimates for the U.S. showed the economy expanded last quarter at only 1.1%, much smaller than the fourth quarter's 2.6% expansion and even smaller than the analyst consensus estimates of 2% for the quarter. Some are digesting this in a hopeful way, believing that rate hikes will pause early this summer, while others are skeptical, thinking it's a glimpse of the recession on the horizon. Earnings over the last 2 weeks have been better than some were expecting, but many companies are beginning to feel the effects of rate hikes, noting subdued guidance. 2 weeks ago, we also received the personal consumption expenditure data, showing a slowing to 4.6% annually versus February's 4.7% pace. This is a good sign, but still well below the Federal Reserve's long-term target of 2%. This led the Fed to raise rates last Wednesday by another 25 basis points, the 10th raise in slightly over a year, bringing the target rate to between 5.25%. Looking forward to this week, we have more corporate earnings as well as CPI inflationary data. Technically, the market is right at key resistance levels, which generally takes a positive catalyst to push through. Given the strength we saw in corporate earnings last week, failing to push us through the level, we'd add some caution here if we were trying to time the market. Thus far, our prediction of a range-bound market consolidating the negative price action we saw in 2022 is playing out pretty nicely through the first 4 months of this year. It would not surprise us if this consolidation trend continued through much of the middle part of this year. Thank you for watching this week's video. If you enjoy these weekly market updates, we would appreciate you forwarding these emails on to others in your network. Thank you and have a great week.